You've heard the phrase, time is money. But in investing, time isn't just money. Time is the multiplier that turns small, consistent contributions into life-changing wealth. Here is a hard truth that might make you uncomfortable. If you wait just 10 years to start investing, you could end up with half the money of someone who started a decade earlier, even if that person invests significantly less money over their lifetime. That isn't a typo. That is the reality of compound interest. And today, on Fiscal Beacon, we are going to demystify exactly how it works, why it feels counterintuitive, and how you can use it to your advantage, no matter your current age. By the end of this video, you won't just understand the math. You'll understand the psychology behind why we delay, and you'll have a clear, actionable plan to start building your financial engine today. Let's dive in. So, what exactly is compound interest? Most people think of interest as something banks pay you for keeping your money in a savings account. And while that's true, it's only half the story. Think of simple interest like a job where you get paid an hourly wage. You work an hour, you get paid. You work another hour, you get paid again. Your income is linear. It grows steadily, but it never accelerates. If you earn $20 an hour, after 10 hours, you have $200. After 20 hours, $400. It's predictable, but it's not explosive. Compound interest is different. It's like having a job where your hourly wage increases every single time you work. Here's how it works. You invest money. That money earns interest. But instead of taking that interest out and spending it, you leave it in. Now, next year, you aren't just earning interest on your original investment. You are earning interest on your original investment plus the interest you earned last year. Your money starts earning money, and then that new money starts earning its own money. It's a snowball effect. At first, the snowball is small. It rolls slowly. But as it picks up more snow, it gets heavier, faster, and covers more ground with less effort. Eventually, the growth becomes exponential. That is the power of compounding. It is so powerful that Albert Einstein reportedly called it the eighth wonder of the world. Whether he actually said that or not, the math doesn't lie. Let's look at the numbers because this is where the magic happens. I want you to imagine two investors. Let's call them Alice and Bob. They are both 25 years old. They have the same financial goals. They both want to retire at 65. And here is the key. They both invest the same amount of money every single month. Let's say $500 a month. But there is one difference. Alice starts investing at age 25. Bob waits until he is 35. Bob thinks he's being smart by waiting. He wants to get his finances in order first. He thinks he can catch up later by investing more. Let's see what happens. We'll assume a consistent annual return of 7%. This is a historical average for the stock market, though past performance doesn't guarantee future results. Always consider consulting a financial advisor for your specific risk tolerance. Alice invests $500 a month from age 25 to 65. That's 40 years of investing. In total, she puts in $240,000 of her own money. Sounds like a lot, right? But thanks to compound interest, her portfolio grows to approximately $1.13 million by the time she retires. Now look at Bob. He waits 10 years. He starts at 35. He still invests $500 a month until he is 65. That's only 30 years of investing. He puts in $180,000 of his own money. But here is the shocker. Bob ends up with approximately $660,000. Let that sink in. Alice invested $60,000 more of her own hard-earned cash than Bob did. But because she started 10 years earlier, she ended up with nearly $500,000 more in her account. Bob didn't just lose time, he lost nearly half his potential wealth. Why? Because for the first 10 years, Alice's money was compounding in the background, silently working while Bob was waiting. By the time Bob starts, Alice's account already has enough growth to generate significant returns on its own. Bob is playing catch-up, but the gap is so wide that even if he doubled his monthly contributions, he would still likely end up behind. This is why starting early isn't just a suggestion, it's a mathematical necessity. Now I know what some of you are thinking. I'm 35, I'm 40, I'm 50, it's too late for me. It is never too late, but the rules change. If you start later, you have to work harder. You can't rely on time to do all the heavy lifting. You have to increase your contributions. Let's look at a scenario for someone starting at 45. Let's call him Charlie. Charlie is 45 and wants to retire at 65. He has nothing saved. He has 20 years to grow his money. To reach the same $1.13 million that Alice achieved by starting at 25, Charlie would need to invest roughly $2,300 a month. That is nearly 5 times what Alice invested. For most people, that monthly contribution is out of reach. However, Charlie doesn't need to reach $1.13 million to live a comfortable retirement. He just needs to start. If Charlie starts with just $500 a month at age 45, he will still end up with over $300,000. That is a substantial nest egg. It's not as big as Alice's, but it's life-changing compared to having zero. The key takeaway here is, do not let perfection be the enemy of good. Start with what you have. Increase it as your income grows, but do not wait. There is a handy shortcut in finance called the Rule of 72. It helps you estimate how long it takes for your money to double. You simply divide 72 by your annual interest rate. If you earn 7%, your money doubles every 10.2 years, 72 divided by 7. If you earn 10%, it doubles every 7.2 years. This rule highlights the importance of your rate of return, but also the importance of time. If you have 20 years, your money doubles twice. If you have 40 years, it doubles 4 times. That exponential curve is what separates the wealthy from the average saver. But there's one enemy of compound interest that we must mention: inflation. While your money grows, the cost of goods also rises. However, historically, the stock market has outpaced inflation by a significant margin. This is why investing in assets that grow over time is crucial. Keeping all your money in a standard savings account, while safe, often results in a loss of purchasing power over decades. Compound interest needs growth to stay ahead of the rising cost of living. So, how do you actually start? It doesn't have to be complicated. Here is your action plan. First, automate it. Set up a monthly transfer from your checking account to an investment account, even if it's just $50. If you wait until you feel like investing, you never will. Automation removes the willpower element. Second, choose low-cost index funds. You don't need to pick individual stocks. You don't need to watch the news. A low-cost S&P 500 index fund or a total market index fund gives you instant diversification across hundreds of companies. This is the safest, most reliable way for most people to capture the market's growth. Third, increase your contributions annually. Every time you get a raise, or every January 1st, increase your investment amount by just 1% or 2%. You won't miss the money in your daily life, but over 30 years, that small increase adds up to tens of thousands of dollars in additional wealth. Finally, protect your principal. Avoid high-fee investment products. Fees are the silent killer of compound interest. A 1% fee might not sound like much, but over 40 years, it can eat up to 25% or more of your final portfolio value. Always check the expense ratios of any fund you buy. We've covered a lot of ground today. We've seen how compound interest turns time into money. We've seen the stark difference between starting at 25 and starting at 35. We've looked at the rule of 72 and the threat of inflation. And we've outlined a simple, actionable plan to get started. The best time to plant a tree was 20 years ago. The second best time is today. Your future self is counting on the choices you make right now. Don't let another month go by without taking one small step. Open that account. Set up that transfer. Start the snowball rolling. If you found this explanation helpful, please hit that subscribe button and turn on notifications. We release new videos every week breaking down complex financial topics into simple, actionable advice. Next week, we're talking about the latte factor myth and why your daily coffee habits actually matter less than you think. You won't want to miss it. Remember, this video is for educational purposes only. I am an AI, not a financial advisor. Always consider consulting a qualified financial advisor before making significant investment decisions. Thanks for watching, and I'll see you in the next one. Keep building